You're scrolling through real estate listings at midnight, and every single house that does not look like it is about to collapse costs $500,000. The kitchen has laminate countertops from 2003. The carpet is beige. There is fake wood paneling in the basement. And the listing agent has the audacity to call it a starter home. Meanwhile, you are sitting there doing mental math on your salary, wondering if you have somehow missed a massive promotion or if the entire housing market has collectively lost its mind. Spoiler alert, it is not you. It is the math. And the math is absolutely brutal. Today we are going to do something that real estate agents hate. We are going to calculate who can actually afford a $500,000 house in 2026. Not who the bank will give a loan to, but who can legitimately afford it without turning their life into a financial stress simulator. Because there is a massive difference between qualifying for a mortgage and actually being able to sleep at night after you sign the paperwork. Let us start with the uncomfortable reality. In dozens of United States markets right now, $500,000 is the baseline. That is not getting you a mansion. That is getting you a 1,200 square foot box with 3 bedrooms, 2 bathrooms, and a yard the size of a beach towel. In cities like Denver, Austin, or anything within commuting distance of a major metro area, $500,000 is what normal people are expected to somehow come up with for normal houses. The median household income in America is around $84,000. So, we're asking people making $84,000 to afford homes that cost 6 times their annual income. If that ratio sounds insane to you, congratulations. You are paying attention. But everyone keeps saying, you can do it. The mortgage broker says you are approved. Your parents bought a house on way less. Some influencer on the internet is flipping houses with no money down. The problem is that everyone is lying to you about what affordable actually means. Let us start with the down payment, because that is where most people's dreams go to die. The old rule was 20% down on a $500,000 house. That is $100,000 in cash. Let me say that again. $100,000. The median savings account in America has around $8,000 in it. So you are not just a little short. You are $92,000 short. And before you say you will just save it, let us do that math too. If you are making $84,000 a year and somehow manage to save 10% of your gross income, which almost nobody actually does, you are saving $8,400 per year. At that rate, it will take you 12 years to save the down payment, assuming housing prices do not go up, which they absolutely will. So, you skip the 20% down payment. You put down 5% or 10% instead, which is what most people actually do. Congratulations, you just unlocked a new expense called private mortgage insurance, or PMI. This is the fee you pay every single month for the crime of not being wealthy enough to put 20% down. It is essentially a poverty tax that runs anywhere from $200 to $400 per month, depending on your loan. You are paying extra money every month for insurance that protects the bank, not you, because they are worried you might default. You are already starting from a position of financial punishment. Now, let us talk about the actual mortgage payment. You put down 10%, which is $50,000 that you somehow scrape together. That leaves you with a $450,000 loan. At current interest rates, somewhere in the 6% to 7% range, depending on your credit, your monthly mortgage payment is going to land around $2,750 to $2,850. That is just principal and interest. That number does not include a single other thing you need to actually live in the house. Let us add property taxes. Depending on where you live, you are looking at anywhere from $4,000 to $800,000 per year, which works out to roughly $500 per month if we are being conservative. Then there is homeowners insurance, which has skyrocketed in the past few years because climate change is making everything more expensive to insure. You are looking at another $250 to $350 per month, depending on your location and whether your house is in a flood zone, fire zone, or tornado alley. Then there is maintenance, the thing everyone forgets about, until the water heater explodes at 11 o'clock on a Sunday night. The general rule is to budget 1% of your home's value per year for maintenance and repairs. On a $500,000 house, that is $5,000 annually, or about $417 per month. And do not forget the PMI we talked about earlier. Tack on another $300. So, let us add this up. Mortgage payment, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. Your total monthly housing cost is now sitting at roughly $4,367. And that is assuming nothing major breaks. You do not need a new roof, and your homeowners association does not randomly decide to repave the entire neighborhood and send you a $3,000 bill. Financial advisors will tell you that you should not spend more than 28% of your gross monthly income on housing. Banks will approve you if your total debt-to-income ratio is under 43%. Let us reverse engineer this. If you are spending $4,367 per month on housing, and that represents 28% of your income, you need to be making roughly $187,000 per year. If we use the more lenient 43% rule, you still need to be pulling in around $150,000 annually. And now we arrive at the punchline. Only about 10% to 20% of United States households make $150,000 or more, which means 80% of American households cannot comfortably afford a $500,000 house under any reasonable financial standard. This is not an opinion. This is just math being cruel. But you are thinking, people are still buying these houses. Who are these people? Some of them have dual incomes in high-paying fields. Some of them have family money. And some of them are stretching themselves so thin that one medical bill or job loss would collapse their entire financial life. Let us look at a real-world example of how this math plays out for a family that, on paper, is winning. Meet the Johnsons. They are two working professionals in their mid-30s, pulling in a combined $160,000 a year. That puts them well above the national median, solidly in the upper middle class. In most cities, they should be living the dream. But watch what happens to that dream when they sign for that $500,000 house. First, that gross income of $160,000 sounds impressive, until the Internal Revenue Service and the State Tax Board show up. After federal taxes, state taxes, Social Security, and a modest contribution to their retirement accounts, they are taking home roughly $9,500 per month. That is their actual money to live on. Now, subtract that $4,367 monthly housing cost we just calculated. Before they have even turned on the lights or bought a single gallon of milk, nearly half of their take-home pay is gone. They are left with $5,133 for every other expense in their lives. Now, look at the rest of the ledger. They need 2 cars because they both commute. There goes $800 in car payments. Car insurance for 2 vehicles adds another $250. Gas costs $300. Because they are highly educated professionals, they are likely carrying student loans that conservatively eat $600 a month. Health insurance premiums that their employers do not fully cover take $400. Groceries for a family trying to eat reasonably healthy cost $800 if they are careful. Utilities for a bigger house, including electricity, water, gas, internet, and phones, add another $450. We are now at $1,533 remaining. And we have not even touched clothing, entertainment, children's activities, car repairs, medical co-pays, or the basic psychological need to occasionally leave the house and pretend you have a life. Savings, emergency funds, or retirement beyond that tiny initial contribution? Good luck. This household is spending 46% of their take-home pay on housing. Not 28%, not even 35%. Nearly half. These are not irresponsible people. They are not buying luxury watches or taking first-class vacations to Europe. They are simply trying to live in a house that the market and their social circle tell them is normal. This is the high-income poverty trap. It feels like checking your bank account before buying groceries. It feels like saying no to your child's field trip because that $35 might be needed if the check engine light comes on. It feels like being one unexpected expense away from disaster at all times. If the heating and cooling system breaks, that is $5,000 they do not have. If someone rear-ends them and the deductible is $1,000, it goes on a credit card. This is the reality for households earning $160,000 trying to own a $500,000 home in 2026. To understand why this is happening, we have to look back at the history of the American family. In 1970, the typical middle-class family had one primary breadwinner and one parent at home managing the household. And here is what most people do not realize: that single income was actually enough. A median single-income family in 1970 could afford a median-priced home, spending about 25% of their income on housing. They had financial margin, and critically, they had a backup plan. If the primary earner got sick or lost their job, the stay-at-home parent could enter the workforce. That second potential income was an insurance policy. Today, the two-income household is the default operating mode. We have essentially activated the emergency backup plan just to cover the baseline. According to data from the Bureau of Labor Statistics, median home prices in 1970, adjusted for inflation, were around $200,000 in today's money. The median home price today is over $400,000. Housing costs have literally doubled relative to inflation, while wages have merely crept up. This created what economists call a bidding war. In the single-income era, families competed for housing based on one salary. When two-income families became the norm, everyone suddenly had twice the purchasing power for the same limited supply of houses. What happened next is simple economics. Prices got bid up. If everyone has two incomes, then two incomes become the baseline requirement just to afford what one income used to buy. It is an arms race where everyone escalated and nobody actually won. The same thing happened with education. Because good schools exist in expensive neighborhoods, families started using their combined two incomes to outbid each other for property in those districts. The price of admission to a good public school became a $400,000 mortgage instead of a $200,000 mortgage. You are not paying tuition, but you are paying the tuition equivalent in your housing costs. And once you are locked into that mortgage, you are locked into needing both incomes forever. You cannot go back to one income without the whole structure collapsing. The housing market does not care about your stress levels. Sellers list homes at $500,000 because that is what the neighbor's house sold for. Banks approve buyers at a 43% debt-to-income ratio because technically the loan will not default immediately. Real estate agents encourage you to stretch because their commission depends on closing the deal. Nobody in the transaction has an incentive to tell you that you are about to financially drown yourself. The system is designed to get you into the house, not to ensure you can afford to live a life once you are there. And once you have signed those papers and moved your furniture, you are trapped. You cannot just decide 6 months later that this was a mistake and walk away without destroying your credit and losing your entire down payment. So, people stay. They stay in homes they cannot afford, working jobs they hate because they cannot risk even a single week of income disruption. They slowly watch their savings evaporate while wondering why they feel so exhausted when they are supposedly living the American dream. This is about a housing market that has completely disconnected from income reality. Home prices have increased roughly 400% since 1990, while median household income is up only about 180% in the same period. The math is broken. Now, you might be thinking that the solution to this broken math is to simply keep renting forever and wait for a crash. But renting in 2026 comes with its own set of invisible traps. We have to talk about what insiders call the rent extraction machine and the hidden loyalty tax that most tenants pay without realizing it. Just like a bank, a landlord is running a business, and the most profitable part of that business is your inertia. There is a specific algorithm used by large property management companies that identifies which tenants are least likely to move. If you have lived in the same apartment for 3 years, if your kids are in the local school, and if you have not complained about maintenance, you are flagged as a high-retention tenant. When your lease renewal arrives, your rent hike will be higher than the market rate for a new tenant moving into the unit next door. They are charging you a loyalty tax because they know the cost and stress of moving is a barrier you are unlikely to cross. On the other side of the equation, we have the trap of the forever home. We have been conditioned to believe that a paid-off house is the ultimate sign of financial success. But in reality, a massive paid-off house can be one of the most dangerous assets you can own. In the financial world, we call this dead equity. Imagine you have $500,000 of equity trapped in your walls. You feel wealthy, but you cannot eat drywall. If you lose your job and your bank account is empty because you sent every extra dollar to the mortgage company, the bank will not lend you money against your house because you have no income. You are sitting on a pile of gold while starving to death. Furthermore, every extra square foot of a forever home acts as a lifestyle multiplier. A larger house requires more furniture, more cleaning, higher property taxes, and more expensive heating and cooling. You are volunteering for a second job as a caretaker for a building. The hidden cost of owning more house than you need is often measured in decades of delayed retirement. So how do you actually win this game when the math is rigged against you? We follow a specific set of procedures to bypass the housing trap. Step 1. Stop treating your primary residence like an investment and start treating it like a cost of living. A house is a place to sleep and keep your stuff. Its primary job is to provide shelter, not to make you rich. When you view it as a cost, you naturally try to minimize it. When you view it as an investment, you use it as an excuse to overspend. Step 2. Use the 5% rule to compare renting and owning. Add up the unrecoverable costs of homeownership, property taxes, insurance, and maintenance. Usually these total around 5% of the home's value per year. If you can rent a comparable home for less than that 5% threshold, renting is mathematically superior. You take the difference and put it into a low-cost index fund where it stays liquid and grows without needing a new roof. Step 3. Reject the starter home myth. The transaction costs of buying and selling a home, commissions, closing costs, and moving fees can eat up 10% of a home's value. If you buy a starter home and move 5 years later, you likely have not built enough equity to cover those costs. You are essentially paying the bank and the real estate agents for the privilege of living in a construction zone. If the math does not support staying for 10 years, do not sign the papers. Step 4. Build a bridge of liquidity. Instead of rushing to pay off a low-interest mortgage, build a massive brokerage account on the side. This is your army. If you have $400,000 in a mortgage and $400,000 in an index fund, you are mathematically debt-free. But you maintain total control of your capital. If life happens, you have options. If you give that money to the bank, they have the options. The housing market of 2026 was built to profit from your desire for status and your fear of missing out. By sitting still, by being realistic about what you can truly afford, and by prioritizing liquidity over bricks and mortar, you officially opt out of the trap. You are not failing at adulthood. You are succeeding at math. Welcome to a life with a margin. The bidding wars are still happening out there, and families are still drowning in $4,000 monthly payments. But you have decided to play a different game. You have built a life where your house serves you, instead of you serving your house. If this breakdown changed how you see the real estate market, hit that subscribe button. We are dissecting the numbers the industry wants to keep hidden every single week. I am Dave, and this is the end of our housing experiment.